Hi folks, this is Sean Hyman from Chart of the Day, and time to take another little field trip. I want to talk to you today about not being fooled because inflation is here and inflation is on the rise, and I want to talk to you about how I come to these conclusions and just take a look at a few things here. This came out tonight as I'm taping it, so not as you're viewing it, but as I'm taping it. Australia has less room for growth without inflation. This is their central banker speaking. And so, yeah, they're going to continue to grow. Their employment numbers are getting better. There's a lot of their data that's getting hotter and better, but it's going to stoke more inflation. This is a very recent report on February the 19th from their central banker. When we back up here and take a look at the U.S. dollar and how it can be affected, I want to take a look at something that happened today. Let me back up. And again, this is today as I'm taping it. By the way, and that's when that says February the 19th, that's Australia's February the 19th. It's actually February the 18th as this is being taped here in the U.S. The Fed raises discount rate as crisis abates. The Fed unexpectedly raised the discount rate today from 0.50% to 0.75%, so a quarter point hike. This is the rate that's charged to banks for direct loans and that sort of thing. So what are they trying to do? They're trying to get the banks to kind of be weaned off of the Fed and the Treasury, and they want them to rely more on money markets rather than the central bank for short-term loans and liquidity needs and that sort of thing. And so the way they spin it is supposed to be a vote of confidence on, oh, the economy's getting better and everything's fine now, so this is something we need to do. But it's not. But it's kind of like a half truth. The economy is not getting better, and that's the. I'm not saying there haven't been some recent improvements in some numbers, but there's also been a huge deterioration in some other numbers. So, but overall, the health of the economy is not good, and they're doing some of these type of measures because they know some serious inflation's on the way. Australia I just showed you where they said, hey, any more economic growth is going to stoke more inflation. The Fed's raising discount rate here, and they just did that on the spot unexpectedly, so it meant that they felt like they had to do that pretty darn quickly because they did not do that in an official organized meeting. But I want to talk to you also about and show you a graph so that you know that I'm not just pulling anything out of thin air. This is literally the inflation numbers, the CPI year-over-year inflation numbers for the major G8 countries. And you got the UK 2.9% year over year, United States 2.7, Australia 2.1, New Zealand 2%, Canada 1.3%, etc. 7 of the 8 are inflationary, and only 1 is deflationary now, which is Japan, negative 1.7%. Really no surprise there. Just a few short months ago, the tables were turned. It was only 2 of the countries that were inflationary and 6 were deflationary. And I'm going to tell you, this inflation came on very, very fast, very, very strong. Yes, it's at fairly average normal levels right now, but the speed with which it got there is what concerns me. The momentum and the speed of the inflation that came on that drove it so quickly out of deflation into inflationary mode, it was quite staggering. And so, if that were to continue, we could have some serious inflation very quickly. You could have 6 or 12 months from now, you could have 5%, 10% inflation where you're having, 2% and almost 3% right now. And that could really happen. That's definitely a reality of what could happen. 5% could come actually very quickly, a lot faster than a lot of people think. A lot of central banks are trying to keep their interest rates between 2 and 3% on a maximum. On a year-over-year basis. And so, most of these are at these thresholds right now. So why aren't they sounding the alarms? Because they don't want to alarm and upset and change the sentiment in the markets. So I'm showing you the numbers that they're not willing to show you. It's not that it's hidden, it's not. But your average guy or gal on Main Street's not going to go out here and dig out the numbers. They're just going to listen to the Fed speeches and trust everything they say. I listen to them and believe what they say when it backs up the data that I see, and when it doesn't back up the data that I see, well, that's the part that I don't believe. So it's kind of like the old saying, you got to eat the watermelon and spit out the seeds. when you follow economics like I do, it allows you to effectively to be able to do that. So let's go to the charts and see what it's doing to the dollar index. The U.S. dollar index, this is a 4-hour chart. When this surprise happened today, it really, broke the dollar across the board out into new highs. As you can see by breaking this resistance level right here. So you still got a pretty serious uptrend in the dollar. In the near term, that's likely to continue because you're going to have inflation growing in the U.S. and other countries. You're going to have stocks caving in, and instruments like the dollar and the yen are going to do very well in that type of environment. Matter of fact, for the longest now, the yen has done better than the dollar. On the upside. And how do I say that? Well, you can look at the dollar yen on the daily chart. I'm going to it right now, and you can see the concerted downtrend that's been there for a year or more. And so what does that mean? That means that the yen has actually been stronger than the dollar, so much so that the dollar's been able to strengthen and gang up on almost any of the G8 currencies out there, and it has not been able to do that against the yen. So that tells you that the yen has been stronger than the dollar, and it tells you that shorting yen crosses has been reaping more profits this past year than shorting majors against the strengthening dollar. And so that's why I developed, the currency cross trader service. That's why I do that, because it allows you to more truly put the strongest currency versus the weakest currency. And sometimes the dollar is not the strongest, and sometimes the dollar is not the weakest. And so it allows you to gain just a higher probability edge, that much more in numbers of pips, and also in the strength, the strongest guy versus the weakest guy, and giving you the highest probable outcome. I'm going to tell you, we've had some great successes here lately in our currency cross trader service, and it's been a phenomenal run of which we want to continue to add to. I hope you've learned something here today about currency crosses, about inflation, about the macroeconomic picture that's able to help you out. Thanks so much for watching. Bye-bye.